Hello everyone, Dave Landry here from DaveLandry.com. This is Trading Simplified. So what we talk about? Well, last week we talked about the knowledge gap, and as mentioned, I was thinking that line of thought was, or line of reasoning was coming from Douglas, and I did a little bit more digging, and I found out that it's actually part of something much bigger they talked about called the potential gap. I want to get a little bit more complex this week, a little bit outside of Trading Simplified, and explain how I use the VIX, or at least start to explain how to use the VIX and what to pay attention to in this present environment. Given the nature of the market, I also want to talk about why we wait for signals and where bad things happen. I'm going to use the TFM 10% system, and I'll show you some trend following stuff that'll help you to avoid bad things. And again, that'll make sense in just a minute. Housekeeping, I do take requests. Let me know what you want me to cover, and I'll be happy to cover it. If you can't fit it in this venue, every Thursday I do a show, and this has been going on for 20 or 30 years. DaveLandry.com/webinar. Would love to have you there. Register once and you're good for all the shows. If you need to reach me, DaveLandry.com/contact. Feel free to send me some requests. And again, I'll fit them in either here or in the webinar. And if you want the presentations, all the presentations that you're seeing here, all the slides, all the systems and setups and all the other stuff I talk about and trend following stuff, go to DaveLandry.com/StockCharts. All right, let's jump into trading psychology. Last week, I began my discussion on the knowledge gap. And the knowledge gap makes you feel like on any losing trade, you feel like if you knew more, you could have avoided the loss. And that's simply not true. That's a potential holy grail hunt. Now, in digging through some of the stuff from Douglas, I found that the knowledge gap was a small piece of what he was talking about called a potential gap. Now, potential gap is where you are and where you could possibly be, the potential of your methodology. And those are often worlds apart. And the main thing that's separating the two is you and your attitude and trading psychology. And just a couple examples on that real quick. One recent and one not so recent. Right around the end of the year, I received 2 emails. One email told me that my trading service was useless and that he was quitting. And the other individual told me that it was their first profitable year ever. Now, I'm not the grand poobah or anything, and last year was a tough year. But my point is, you have two individuals, same exact information, and 2 drastically different outcomes. So the only thing between the 2 that's a common denominator would be their attitude. One had a good attitude for it, and the other one, I'm guessing, did not. Now, last year was kind of a year of small margins, so it could have just been a few mistakes one way or the other. But as a general statement, for somebody to actually become tradable last year, that's pretty impressive. Now, let me take me out of the equation and give you another anecdote here. Years ago, I was speaking in Germany, and there were 2 traders in the group, and one was profitable and one wasn't. Now, you might initially think, well, maybe they had different information. No, they had the same exact information, and they were trading the same methodology. In fact, they were trading partners. They actually traded together. Now, one did have a little bit of an advantage. He was a world-class poker champion player. But if you think about the other guy who didn't have those mad poker skills, all he had to do was just kind of mimic his partner's trades until he began to believe in the methodology and could follow it himself. And he got the reps in and then was able to have enough discipline. Now, once you have a conceptually correct methodology, stress over a knowledge gap means that you are assuming that there is a holy grail which does not exist. So if you lose on a trade and you're thinking, if only I knew more, well, once you have just a rudimentary level of trading and you understand trends, you understand money management, you understand the basic stock selection, all those things that are preached quite often, then you could eliminate the knowledge gap, because believing there is a knowledge gap makes you think that there's some sort of holy grail, which there isn't. So you want to reach the point where you're confident in everything to where that knowledge gap goes away. Now, there are a lot of other things that can stop you from reaching your potential. Discipline is a big one. My big takeaway with discipline is it gets used up. And the gym is a great example for me. If I work hard all day and think I'm going to go to the gym, I'll never go to the gym. I've tried it many, many, many times. Instead, I just go in the morning before the market opens, and I don't even think about it too much. And I've developed that discipline over the last couple of years. Discipline, again, gets used up. And if you're chasing too many markets, your discipline begins to erode. And that's where you got to be really, really careful about over trading. Focus is another one. It's similar to discipline, where if sometimes you're not seeing the forest for the trees. If you're watching the flickery ticks, as Dave Keller calls them, and I think he got that from Todd Harrison, and you're not too close to the market. What's the old saying? Be as close to the market as you need to be, but no closer. And for that focus, you could probably put some commitment devices into place. And I'll talk about those in just one second. Extreme patience is really often needed. And I was looking at some old presentations, and I forget the exact time period. But I remember in one of those presentations, I pointed out that we went 52 days from setup to setup, from trigger to trigger in setups. And this is in position trading, so that's 2.5 months where no new action was actually taken. I didn't plan it that way. It's just that we had mediocre setups that I didn't take or show, or that looked decent, didn't trade based on market conditions. You're going to need confidence, and in order to reach your potential, you'll have to have confidence in your methodology, confidence in yourself. And the only way to get that is just through a lot of reps. And through those reps, you'll learn to see what is. The market might not be doing what you want it to do, but what is. Extraneous influences is another thing that can keep you from reaching your potential. And I talk about that quite often. Right now, for instance, in some of the intraday trading I'm doing, because it hasn't been going well lately, it went extremely well not too long ago, and then it's kind of all come unglued. But I find myself not fully adjusting to the volatility. So my own trading is influencing my new trading. That's a big one. But in general, when I talk about extraneous influence, I'm talking about what's going on in your life and everything else. And trading will affect your trading. Your life will affect your trading. Your trading, when it's going poorly, of course, will affect your life, and then it can become a negative feedback loop from there. So you have to be really careful about those extraneous influences. Go in and watch all the presentations that I've done where I talked about those things. Now, I've identified some potential problems, and usually the solution to most of your problems can be all boiled down to document. I know I beat the dead horse on this, but it's very, very important. Now, I often talk about the post-mortem and how important that is, but one thing that you need to do in addition to the post-mortem is a pre-mortem. Before you take that trade, pretend you were explaining that trade to someone after you took it. I took this trade because the trend was very good. The trend was accelerating. The trend was persistent. There was no overhead supply. And all those other things that I'm always beating the dead horse on. Now, of course, you need to do your post-mortem and go back and look at it. And two things will happen when you start doing that on every trade. One, sometimes you'll think, what the hell was I thinking? But that's okay. You can go back in and say, well, I don't want to do that again. You could time travel, next trade, right? How are you going to feel after this trade is done? The true enlightenment comes when you look at a trade and you say, you know what? The trend was there, it was accelerating, was persistent. We had a nice little knockout move, like a TKO type of setup. Everything was perfect. It just didn't work out. It, spelled with a silent SH, happens. Now, the other thing you need to do to prevent aggravating your future self is think about the trade from a time travel perspective. Very similar to the pre-mortem, but if you were to stop out of this trade and let's say it failed miserably, was this really a must-take trade or was this a mistake trade? And again, documenting is going to really help. You'll eventually write things like, this isn't that great, but I feel like doing it anyway. And then you realize, boy, that was stupid. Now, what's going on with your life? And that's the extraneous influence and all. And that's where your morning pages can really help. Just wake up every morning and write 3 handwritten pages. I know I've beaten a dead horse on that, and I will continue to do that. It's one of the best things I've ever done in my life. Trading journal. Document in your trading journal what you did, of course, plus your emotions at that time. What you didn't do, plus your emotions at that time. You didn't take a trade or you didn't put in a stop. What were your emotions? What was happening? And here's the crazy thing about trading. You really have to be vigilant in all this stuff. And one thing I found was I was making a lot of trades after lunch on the intraday stuff and losing money. And it wasn't until after I reread a book where they talked about judges giving more lenient sentences in the early afternoon as opposed to the late morning. And the reason they did that, they figured out, was the judge wasn't hangry. He was able to have a nice lunch. He was in a good mood, and he paroled a lot more people or gave lighter sentences, whatever the case may be. I discovered that, hey, I'm in a good mood. I just ate lunch. I'm feeling good, and then everything looks great. So one of my little commitment devices I did there was whenever I walk in the office, I write WITO for a walk in the office. So any trades I make really close to walking in the office, I know that I might be influenced by feeling good because I have a full belly. Shame. I write shame quite often, way too often, but if you're doing something you shouldn't do, then write shame in the margins and come back and figure out a way not to do that again. And think along the lines of what commitment devices can you put into place to become better. I'll give you a case in point. Instead of just jumping in midstream on stocks, make sure you have a specific entry in mind. And that stop entry order will, in many cases, keep you out of trouble because sometimes a stock pulls back and it never does rally enough to trigger and then it implodes. Now let's shift gears and talk about some trading not so simplified, something that's a little bit more advanced. And that would be using the VIX for trading in and of itself, short-term market timing, and analysis. Now, the VIX is the price of hypothetical at-the-money puts and calls 30 days out. So it's a hypothetical, but it's based on real prices, and it's a big, huge formula, and I have no idea in the world how I would even go about understanding it. But all you need to know is it's looking at the at-the-money options on the S&P, and it's looking at both puts and calls. Some people think it's just puts, but no, it's puts and calls. And it's this big old formula again, but just know that it measures the fear and complacency. The options tend to go down in price when there's not a lot of fear in the market, and the options tend to skyrocket when there is a ton of fear. So if there's a panic, option price is going to skyrocket. If there is complacency, option price is going to kind of dry up. Now, one thing to understand is we're talking about volatility here. Now, volatility tends to revert to the mean, to the moving average, and often overshoots. So it'll come back to the moving average and just keep on going, or sometimes it'll get really stretched before it comes back in. But these situations, especially when it's stretched one way or the other, can be quite useful. Now, again, it tends to revert back to the mean after getting stretched, and then markets tend to reverse after the VIX is stretched. Now, tend is the key word in those sentences. If you were to, by the way, if you get the slides, daily.com/StockCharts, you can grab this link out of here and you can get these exact charts. But you can see here, this is the VIX, and I just put a closing VIX in, and then I put a 10-period simple moving average. And the genesis of the VIX stuff that I do goes way back in time, and I was counting the years. It's over 30 years now, which is scary. But it's way back in the day when I worked with Larry Connors, and he did a lot of VIX research, and he explained to me that the VIX tends to revert to its mean. So I used the word mean as moving average, and I started developing some VIX systems along with him using moving averages. But you can see here, as a general statement, when the VIX gets stretched about 10% or more away from its moving average, it tends to revert back to the moving average. And when it gets stretched to the upside, it tends to implode back to the moving average. And you can see not that long ago, the market became complacent. It was kind of drifting higher, and the VIX dropped sharply below 10%. And this huge sell-off that we just had was led from a very low VIX reading. And you can see that it's since begun to revert back to its mean. So let's talk about what this means in terms of the stock market. Now, when the VIX is stretched, and by stretch, again, I'm just using 10% or more away from its 10-day simple moving average, there tends to be panic in the market. The option prices are very high because there's a high level of uncertainty. Now, complacency can be defined as when the VIX drops 10% or more away from its moving average. People have become very comfortable with the market, and they're not pricing in big moves, and usually that's when you get a big move. So let's take a look at what happens, or tends to happen, I should say. Right here you can see the VIX is fairly stretched. It's about 17%, and the market had a little bit of a pop. Down here, stretched to the downside. You can see the market turn back down. Now, by the way, once you see a trend developing like this, you don't really want to fight it, but it's okay to use some of this VIX stuff to catch a bounce on an intraday basis at the least, and possibly trade the VIX in and of itself. You can see here again, we're stretched to the upside, and then the market bottomed out and had a decent rally. Now, in more recent times, the market became complacent as the market was beginning to rally a little bit, and then we've got this big sell-off here, and then now we've become stretched to the upside, suggesting we should get a little bit of a bounce. And at the least, the VIX itself did implode. Now, remember that it's hypothetical at the money, puts and calls, and it's 30 days out. It's looking at the implied volatility on those things. It's a big old formula, but just know that it measures fear and complacency. You don't need to know everything about electricity to flip a light switch to get light. Now, keep in mind, it only matters when it matters. In other words, you can get stretched quite a bit in one direction or the other, but once it does get stretched, pay attention to that reversion to the mean move. Also, use it with a weight of evidence approach. If you're getting buy signals within a pretty serious downtrend, be careful with that. Again, you probably just want to do this stuff on an intraday basis. My original VIX systems were multi-day trends, looking for multi-day movements and multi-day trends. However, what happens with those is, in a lot of short-term trading in general, it'll print money until it doesn't. You get a big trend and then you lose all your gains. So I'm more excited about signals and just looking at them on an intraday basis, especially if it's stretched one way or the other. Again, don't fight the trend. Sometimes you're going to have smaller corrections within the trend itself. There are possible big moves from overbought and oversold, but you want to be really, really careful when you're doing such trading. I'm not a big fan of trying to catch overbought and oversold, but if you're trading on an intraday basis, keep an eye on that VIX, and if it's super extreme, you know you're getting to a point where the market is likely to have a pretty big bounce. Now, be careful, again, holding positions multi-day. Like I just said, it'll print money until it don't. I've gone through periods where I looked at some of the VIX stuff that I developed many, many years ago, and again, it just absolutely printed money. Unfortunately, you hit a period like coming into the pandemic or even possibly the bear market we're in now, and things don't work as well, at least on a day-over-day basis or a multi-day basis. Now, be leery of VIX futures because that just complicates things even more. That's a derivative of a derivative of a derivative of a derivative. I think I've got that right. It'll make your head hurt if you try to think about it too much. It's okay to trade them intraday, but you don't want to hold VIX futures longer term. There's a lot of problems with holding futures or more for more than one day. Now, the other thing I see that happen a lot is people use just generic technical analysis with the VIX, and you got to remember that VIX is not actually price, it's volatility, and volatility is going to act more like a reversion to the mean type of market. It gets stretched and then it tends to snap back. Now, when it snaps back, it does tend to overshoot itself, and that's a propensity we could use to our advantage. The volatility is asymmetrical on the upside. So we had a little bit of a panic just the other day, and then I saw intraday readings of 50% or more. Remember, anything above 10% is stretched. So if you are going to trade the VIX, err on the side of being long the VIX, because when it really takes off, you can make a lot of money in the process. Now let's shift gears and talk about why we wait for signals and a related topic where bad things happen. Now the TFM 10% system requires 2 bars of Landry light using a 50-week moving average on a weekly chart, but it also requires for a buy signal for the market to close above the buy line. In other words, within 10% of the 50-week closing high. And as you can see a few weeks ago, that did not happen. And right around that time, I wrote a quick article that the market sees a shadow. I'm going to have 6 more weeks of bear market. And so far, let's see, 1, 2, 3, 4, I guess 2 more at least. A couple of miracles would have to happen. We're at least 3 weeks away from a possible buy signal. So this was not a buy signal. And as you can see, so far at least, the market rolled back over. Now, speaking of rolling over, if we're looking at the 10% line, as I call it, the buy line, notice that when you drop below it, not every time, but often bad things happen. And in more recent times, obviously, we spent a lot of time below that 10% line, which is 90% of the 50-week closing high. Just let the computer plot it for you. There's been a few times in history, just going back about 20 years or so, where it didn't really come unglued, but it did kind of clue you into the fact that times weren't really great. And if you go back to 2015, 2016, those were horrible times for a trend trader, and it was a good time to be mostly out of the market. And there were some signs, especially on a daily chart, that did keep you out of the market quite a bit. Now, of course, we had some more spills here and there where it drops below the buy line, and the most recent one, of course, was the pandemic, and that was a pretty nasty spill. Where bad things happen comes from Guyad and Baleo, and I haven't read their article, I haven't found their article, but they wrote an article that won some awards, and they were basically talking about the 200-day moving average, and we'll look at that in just one second. But you can see here you had downside Landry light, and that was in 2000. This is just using a 30-week exponential moving average. And then you had downside Landry light here, and of course we had that bear market in 2008. And then right now, for most of 2022, we've had downside Landry light, and now we're back to downside Landry light for 2023. So we're going to have to pay attention to this, and the whole point that they were making was that once you have weakness in the market, it can beget more weakness. So pay attention to these times. And again, there's the pandemic. You can see pretty serious slide, even though it was very quick. Now, shifting gears, weekly bow ties. Again, major bull markets and bear markets tend to happen. Bad things tend to happen after you get that downside signal. And you can see this period here wasn't fantastic. It didn't completely roll over, but it was a pretty substantial sell-off nonetheless. Again, 2015, not a pretty time. And this is just bow tie proper order, meaning that the 10 is less than 20 and 20 is less than 30 for the bow tie moving averages. And again, a couple of periods in here, and of course the pandemic. Now the pandemic signal was late, but that's okay. We had plenty of other signals, including the TFM 10% system. And you can see we've been mostly red or yellow at least for most of 2022 and some of 2023. The old death cross can be a signal where bad things happen. Pay attention to the magnitude of what happens after a death cross, not the signals in and of themselves. The signals really won't test out, or not spectacularly, but the magnitude of what can happen once something bad happens can be really ugly. Now, once again, this particular indicator, because it's a lot of lag, it can be really slow to catch up, especially in a V-shaped recovery like we had back in 2020 during the pandemic. But again, there were other signals back then too, as we've talked about quite a bit. But when you're looking at that death cross, just pay attention to the magnitude of what's possible when you have it or any other trend indicator to the downside. And this obviously is going back to 2008 in the S&P 500. Well, that's all my time. I want to thank everybody for watching. If you need follow-up information, davelandry.com/StockCharts. If you need to reach me, davelandry.com/contact. Again, thanks for watching, and may the trend be with you.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.